continue to do that. And you can log in if you want on this as well. And or if I need to do this, so yeah, and I'm going to keep doing this with like underwriting. I'm going to do it with the product type. So we're going to do like next week. I'm going to try to set up a bunch of. So like next week, you're basically going to come in, do your, we'll probably just set it. We'll try to ramp you up, but let's just say we're going to set you at 15 for the day. So we want you to hit your numbers, and then the following week will be 20, right? And then as you get in the rhythm of things, that'll just be your consistent deal. And then what'll happen is in the afternoon, like you're going to start doing training stuff like this, plus you're going to be doing like the deal that I'm talking about now, which is like live, like this guy, we were just on the phone and he sent over the pro forma. Nice. And so you'll start going through that and learning. So I'm going to have you essentially. So like on this deal, I'll pay you 20 grand. Okay, essentially. So you're going to work the deal. So you're going to do all the, so I'm going to do the front end work. I'm going to have all the interactions with the client, but you're going to do all the back end work of prepping and underwriting, reviewing it, interacting with the lender, because I always, I'm totally fine with fumbling explanation. So, okay, so this is the Integrity Capital recording for analysis, underwriting for an owner-occupied conventional transaction. So we're going to spend some time with Kevin MacArthur, with Sunflower Bank, who was generous enough to offer some time and walk us through how to underwrite, how to do the analysis, how to do spreads. These are all synonymous names for looking at a transaction or a loan on the commercial side for owner-occupied facilities. So Kevin, thanks for taking the time, and why don't you dive in, and I think you should have the floor now for the screen, hopefully.
Okay, let's see.
You walk us through a little bit of the high points on what the deal is, and then we can dive into some of the numbers.
All right, so how do I share my screen? Oh, okay, here we go.
There it'll say share screen. You should have authorization at this point.
All right. Can you guys see the screen yet?
Sir, we can.
Okay, so what you guys see, obviously, James and Dix and all that stuff. So let me go here. I'm going to open up, kind of start. I sent over the Mangat one that we're working on. So obviously we spread their tax returns each year. And this is like kind of a owner-occupied deal due to the fact that we're looking at global. So I'm just going to kind of back into it because I'm using your guys' financials. So let me pull my credit presentation up to here. So typically, so basically on owner-occupied real estate.
Did you? I don't see the credit presentation. Do you want to share that?
What do you mean by credit presentation?
Well, your spreadsheet, is that what you're trying to show us?
Yes.
Okay, I don't see it. I see your email, so you might want to unshare and then share the actual spreadsheet. It's kind of one by one.
Oh, okay.
Sorry.
Let me okay. Sorry, I worked with 3 screens here.
That's okay. So if you end the share and then you share, there you go. I think that worked.
So how do I end the share?
Yeah, let me do this.
Oh, here it is. I say stop sharing. Okay.
Okay, there you go.
There, I see.
So then you can share.
Share screen.
And I'll tell you.
There we go. Share. All right, can you see it?
Yes, perfect.
Okay.
Okay.
All right. So we're gonna start. See, I have a lot of tabs I look at, so sorry. Bear with me. So when I start with an owner-occupied real estate, I typically start by getting the spreads done, which is you go pull tax returns, you look at the revenues, cost of goods sold, and you kind of go through what you're looking to do. And so since I'm using old financials, I'm just going to use a hypothetical here for
Yep.
Mangat as if it were, it was the investment, or it wasn't an investment, but it was an occupying tenant in a commercial real estate loan. So we would start with the spreads and make sure they cash flow. And we're just going to say that Mangat is looking for a $1.7 million property loan. And you can see, you can look at the financials and you look at just what the business could withstand for cash flow at 1.33. So that's based off the 6/30/2020s. If we were to try to give them a SBA or a Sunflower Bank $1.7 million owner-occupied real estate deal, we look at what the business cash flows. We don't really look at the property level because that's a pass-through and that's going to be a wash.
Okay.
Because obviously the business pays rent, which you don't see here, but you would see a rent tab, and you would just minus that out because this business wouldn't be paying rent if it were to absorb the loan. So we kind of just start with a historical just to see if it cash flows at a 1.25 or better.
So what you do, I'm going to interject just to clarify. So what you're doing, you go back to that tab, is you're taking the gross revenues up top, cost of goods sold, all the expenses, and getting to a net operating income.
Yep.
And then what's happening is you're then essentially taking all of these cash adjustments, which are, what would those be, for example? So,
well, say the tenant for this one, Mangat, it's a trucking company. So they say to sell off some trucks, and they gain some money from the sale. So we'd have so that basically they made money that year from selling some stuff. They could have other income from, another company that passes through income to them that doesn't occupy the property, but the cash flows ran through Mangat. Then you could have other expenses throughout the year that typically you wouldn't see on the above line items because they're one-time expenses. And then we have the interest expense, which obviously it's taken out of the net income. But when you go down to EBITDA, you're going to see that it's added back because you add back depreciation and interest expense because we're basically going to be doing a new loan in that place.
Yeah.
So that's how you get your EBITDA, and that's what we underwrite off of.
So you're going off of earnings before interest, taxes, depreciation, and amortization.
Yep. We don't do the rent. We don't do EBITDA because obviously we're taking the rent out because
unless it's a rent replacement, right?
Yes.
Okay. So then you get to your EBITDA.
Yep.
And then what is the cash flow after debt service? Is that what that is?
Yeah, cash flow after debt service, absolutely. Because this is cash flow after debt service, and then this is our proposed debt. Obviously, we know Mangat has a trucking company, so they have some freight lines, they have some other real estate they own that they don't occupy, that they have investors on. So we have their existing debt, but this is our standalone 1.7, and you can see this year it didn't make it, but in 17 they're crushing it at 2.47.
Right.
So we kind of look through and we look at the story, and like you said on this one, it was cyclical due to the business. So down year, up, down year. It should be up for the next 2 years, and then there's another story. But basically, what we're trying to do is make sure the tenant, because on owner-occupied real estate, normally they have a holding company, and then they have the tenant, and they have a lease. But if you really think about it, the lease is between them just so they can expense and pay less taxes at the property level.
Okay.
And so we just kind of look at if the business were to absorb the loan, could it cash flow?
So and then once you so your debt service on the 1.7 million is the 85,000 at the bottom.
Yep.
But is this technically just an analysis on the business itself, or is this also doing a global?
No, so this is just the business. I will go to my global cash flow table second, right after. I'll go right now.
Okay.
So typically, For global cash flow, so I would take the company, enter their 3 years financials, what the net profit is. You can see that the interest and expenses added back. So we get total cash flow. And then obviously there's owners of the company. So they take dividends or distributions, I would enter them here.
Do you take that out of the cash flow then?
The company cash flow, yes, you do.
Okay, so you deduct that out of the cash flow.
Yes, because it's going to flow into the guarantor's total gross annual revenue.
Yep.
So it's a wash, but you want to show it.
Yeah, got it.
So it essentially shows here, it'll get minus here, it'll get added here. So, and then you kind of do that, and then you get your total global cash flow, which, so say if the property made, made 2,400,000, interest was like 156 or 552, and then you had depreciation of 100. That's it, and then you had to say you took $2 million out.
Okay.
So, and then say you paid himself a salary of 100,000. So we'll show, we'll show that. So see that 2,000 washes here because he only paid himself a salary of 100,000.
Okay.
And then say he pays taxes on the 100,000.
So you subtract the taxes, which you pull from the tax returns, right?
Yeah, exactly. So his tax returns will show pass-through revenue of probably the 2,652, and then he'll have deductions personally. So let's just say we take this number and times it by a tax bracket of 0.25. Oops, that didn't work. Equals that. So that he pays 525,000 taxes. His living expense is deducted by 15% of his gross annual revenue or his gross cash flow. So at the end of the day, our total global cash flow is 1,991,000. And let's just say, for the sake of trying to be in line, you say it's 634 and 85. So 719 would be the total. So we'd say the proposed is 85. Existing debt for the company is, what was it? 634. 634. And then now his guarantor debt. So he makes $100K a year, and say he's got a house, he pays $2,000 on a month. That's 24,000. He's got a car, say that's 1,000 a month. That's, you look at 36,000. So then our global cash flow would come to a 2.64 based off the guarantor debt, the existing company debt, and our new proposed. And that's how you would run a global.
Okay, so the way this works then is, so I'm clear, you've got the company cash flow, which is the net profit plus interest expense plus depreciation, taking out dividends and distributions.
Yep.
Then you go down to the personal, and you have the 2-1. Now, let me ask you a question. On the tax returns for the 1040, do you actually take the, are you just taking the W-2? Or are you taking, what do you accept and don't accept?
So here, I have a chart for which we can go over for individual cash flow. So we take the W-2s. Okay. If they have any, say, right here for this non-cash benefit, Social Security, Medicare, we take that out because it's, W-2. We want to make sure that Social Security is reoccurring, or we take it out. If it's reoccurring, we would leave it in. We don't minus it out.
Okay.
And then you go to basically Schedule B, and you look at their interest and what they get from non-LLC entities. If it shows pass-through interest income from an LLC entity, we will remove it.
Okay.
Because it's basically to the business. And so we go through, we'll fill out this section, and you see right here, less K1 interest, less K1 dividends, because that's not really going to them. And then if they have a Schedule C, which would be your taxable business income, we would complete this section based off the Schedule C.
Yep.
And then this section right here with this taxable rent and royalties, that's gonna be your Schedule E, not page 2. It's your first schedule, which will show all rental income. And then you'll add back the depreciation, you'll add back the expense.
Okay.
And then right here, this is where you get K1 distributions. So you would put all K1 distributions here because that is cash flow to the to them. They're pulling out equity out of these businesses. And so we'll look at that. And then you also want to make sure that if they have any guaranteed payments, which a lot of people don't, that you account for those as well. But you also definitely want to take out any capital contribution so you're not having a bloated distribution number. I won't lie, I've never seen taxable farm income on a tax return.
Yeah.
So I really don't use this section at all. But if it were ever filled out, I'd figure it out. And then pensions, IRAs. This is we'll only enter this.
Do you deduct the IRA annuity distributions? Do you not count that?
Not unless it's reoccurring. If they are of age to get a pension, an IRA, an annuity, and I see it for over 3 years, I will continuously use it. Or say it's their first year and they let me know, like, hey, I just hit 65. So last year I got my first distribution from my IRA, or I got my pension started paying. Then I will start giving them credit for it. But they have to be over 65.
Okay.
Because if not, say it was me and I took a IRA distribution because I wanted to buy my house last year, then that's not, like, that was a one-time expense. We'll take that.
Okay. And then what about the so short-term capital gains? What do you do with that, or long-term?
We remove it every time.
Okay. Yeah.
Short-term capital gains are normally people that are playing stocks and it's very volatile, and they're either flipping and trying to make a quick buck because they're not held over a year. So we kind of take it out because they could have had a hot year, they could have had a really down year. We don't want to penalize them if they had a down year because they gambled basically, and then the next year they have a hot year. It's just too up and down for credit, so credit kind of takes that out and doesn't look at it.
Okay.
And normally the proceeds from the long-term capital gains, it's because they sold an asset they had over a long period of time. So we don't really use that either.
Yeah, agreed. And then you deduct the taxes again, and then how do you calculate living expenses for people?
So living expenses are normally what I do, me personally. I'll go back to up here, where is it? To my global cash flow. It's 15% of taxable, of the total gross annual cash flow. I'll take 15% of whatever that number is.
Got it.
So going back to here, basically I'm going to take this cash flow from assets, and I will go right here and I'll go enter up times that, and I'll times it by 15%. And that would give me my number. So say I had, say I made that, then it'd be $350,000.
But that would go under living expenses, right?
Oh yeah, sorry.
And so, okay, and then you're pulling all of this from the 1040s, Schedule
Yes.
1040 for the personal. Okay, got it. Okay, do you have questions on that? Did that make sense?
Yeah, it definitely did. It's nice.
I will be more than happy to share this template with you guys. I will just take everything out and give you a blank one.
That'd be perfect.
Awesome.
Yeah. Okay, so keep going. So where else do you go after this? This is terrific.
So normally I do the income statement of the business, and then
Okay.
I go do the individual cash flow. And then I go, after that, that's when I go to this global and I enter it, and I do this for 3 years. And after I see it 3 years, I see if it works. If it works, I'm like, all right, cool. Basically, I know the deal works at that point. So it's off to the races for me. But being an underwriter, I really want to go see the liquidity of my borrower or my guarantor.
Yep.
But normally I will go take their PFS and look at it. So if you'd like, I will go through how I decipher a PFS.
Why don't you let us know how do you decipher PFS?
Okay, so I didn't bring one. I'm outside my VDI right now, so I can't go pull one up. But when people put down on their PFS, they put, oh, I have cash in the bank. Well, that's going to be your liquid assets. And then so under marketable securities, that's normally stocks or bonds, something that they could sell without getting penalized. Because as you can see down here, IRAs, 401ks, that's all going to be retirements. And I normally discount those at a 50% clip. So say you have $1 million and my adjusted net worth, you're only going to get 50% of that, of a retirement account. Other real estate personally owned, I will leave that in. I'll leave their personal residence in, but I will also account for the debt down below. But if they have other real estate owned in an LLC, I will remove it from the adjusted net worth. Because I have no recourse to that because it's in another LLC. If it's on his personal name and the LLC is not tied to my loan, I cannot give him credit for it on my adjusted net worth. On his stated net worth, I can give him credit for it, but I can tell you my credit team is going to go to this line right here, and they're just going to look at adjusted net worth.
Got it. And then,
On top of it, because we're going to show, say this was owned in an LLC, and let's just go say someone has 30,000 in cash, they have say 750,000, and that their residence is worth 400K, and then they have 3 million in other real estate owned. If you were to go down here at the very end, I'll show you. And then so say personal property's got a car worth 60,000, and he's got 20,000 in jewelry. Great. His primary residence may have 300,000 because because the value of it is 4, so that's decent. And then the other real estate, say he has what I would call contingent liabilities. So I'm going to put, say 3 million, he owns 2.5 on it. And then he has maybe some credit card debt. So say he has 20,000 there, or the consumer debt, sorry, that's the car, which is say auto, it's 60. And then he's got the credit cards and it's 15. When I go to the adjusted, I basically go and remove, and since this isn't owned in his personal name, I'll go minus that out. And then I'll add back this other real estate debt because that's got to get removed too. And it kind of gives you his adjusted net worth because you're taking out these two bloated numbers. You have his marketable securities and personal residence, which only really has 100,000 in equity, and it gets dropped down and kind of knocks it down and adjusts the net worth from what you guys think it is to what it's worth.
how much do you guys really focus on a client's net worth? I mean, what are you really looking at?
For me, this is adjusted net worth because honestly, this LLC, that's kind of, we know to take that out. We know to take that out. So I'm looking, okay, he's got 30K, he's got marketable securities. That's great. But if this is a $2 million deal, that's kind of light on the adjusted net worth because there would have to be a story there. And it's like, well, for me, I live a modest lifestyle, but as you can see, I put a lot of my investments into other real estate. And say he's like, well, and then I leverage that so I can go buy more and more. It's just, you want to get the story because the adjusted net or the net worth stated looks great, but it's all hidden in other LLCs. If this was like an investor, like that, it just depends on the deal. But I know liquidity is kind of where credit likes to see stuff. But to me, I kind of look at a deal as what's my collateral, what's my cash flow first. Does the deal cash flow? And then after that, I go to the collateral. Is the collateral sufficient? What's my LTV? In a downturn, how am I going to get paid back? If I sell the property, if they say the cap rate goes up, the value drops, what's my cushion of where I need to sell before I'm going to take a loss? But typically, if it's owner occupied, you're going to have the cash flow first, the collateral secondary, and then you look at the guarantor really as the third spot. Because it's like, could they cover the payments? Do they have excess, I want to say cash flow? They have excess cash flow to support the debt. How long until they get into trouble? So I look at the big picture. I don't really hurt them or say, oh man, they only have 30K in liquid assets. I can't lend to them. That's not how I am. And people that are like that, they're not taking time to learn the borrower, learn their story. They're not putting effort in. They're just looking at numbers and going no or yes real fast. And I call that box mentality thinking. Wow. And a lot of banks do that and will turn down a deal before actually knowing what the character of the client is. They because some of these people, they are good people and they're the kind of people due to character, as we were talking earlier, they're going to pay their debt. Sure. And that their name's on it, they're going to pay it. And that's how lending used to be. And it's sad that we got away from it because so many people took advantage because of character issues.
So do you, okay, so then what else do you look at on I see you have a couple of other tabs. What other things are
so right here, I look at the credit score. I won't lie. Credit score doesn't really mean much to me, I want to know what their payments are. Like, because somebody could have a medical billing past due for $200 and their credit score is 650, but all their other accounts are paid on time, no delinquencies. And I go to them and I go, hey, what's this medical bill that hasn't been paid for $200? Well, I'm in a dispute with them. I'm not paying it, but that crushed their credit score and it probably should have been 700. So I take FICA at face value. I want to kind of see what their accounts look like, what their balances are. Are they over leveraged? Like, and then I also look in my notes over here. I put their pay scales. Do they have any late pays? Do they have any derogatory items mentioned on this? Do they have a BK? Like, because you'll see all that on a credit report, and so that's kind of where I go. Like, and that's like kind of the final test, because you want to make sure you don't have, hey, everything checks out, great credit score, 750, all this looks good, the deal looks great, but then you find out he has two BKs and a foreclosure, and you're like, what? And you find that out, but the FICO score wouldn't tell it because it was over 5 years ago. You're gonna be like, I need the story on something like that because that's a character issue. You filed BK twice. You had a foreclosure on a piece of property you owned. What makes you say you wouldn't do that to me at a later date?
Okay, got it. So you're looking for the story and particulars more importantly. What other tabs do you also look at as well?
So this is for investor deals. I'll just show you. I have this little template straight off the Schedule E. If it's an investor deal off any tax return, you're going to have the income, the vacancies for my analysis, but you're going to have the income, you're going to have all these expenses. And then I tie this to the global cash flow where you get the debt. But you basically want to make sure you cash flow right here at a 1.25 or better on investor deals. And, if there's add backs, you make them accordingly in the pro forma. But this is pretty standard real estate that I created myself because I won't lie, banks I've worked at before had Walter Kluwer's cash dashboard and would do this for you. So every other bank I've worked at except Farmers and Merchants, I've had to use this Excel spreadsheet.
Can you explain, Kevin, what is a debt service coverage ratio, just so the audience can?
Yeah. So we go through them, and basically you have NOI, which is your net operating income, and that's basically gross revenue minus your expenses. And then here's your debt. So you basically have your debt divide your NOI divided by your debt, and that's basically what your ending cash flow is after expenses. Whatever your revenue is minus expenses divided by your debt is debt service coverage ratio. Banks live and die by this, because if you're not 1.25 or above, they're not going to say yes, or they're going to say no every time.
That's good.
Unless it's multifamily, because some banks will go 1.15.
Right. Now, do you, Kevin, just for the audience to understand, does that have to be a debt service coverage ratio in that period? Does it have to be for X years?
You want to see historical. So you want to see every year you analyze at the end of the year, you're going to want to see it, that they hit that margin of 1.25. It's kind of industry standard. But say I have a 1.25, a 1, and a 1.4. I'm going to ask, what's the dip for? Did you go through, was there an insurance claim? Did you do extra landscaping that year? Because if there is, there might be an add back to bring it up. So even here, if you see anything funky out of the norm and you don't see 1.25, I'm not saying the deal's dead. It's what was the story? What happened in that year? Did they have a fire and they had to exit half of the building to do repairs, so their income dropped and their expenses went to the roof? So this DCR shot way down. There's multiple avenues. So I'm really big on the story, because that's where you're going to get to know what really happened. You can't just go, oh, that's interesting, that's a no, because there are instances where no one's perfect. There are instances that are explainable, but if he's like, oh no, I just had mass vacancy and I couldn't keep up with getting people in the door, now I have month-to-month rent, I'm going to be like, that might be a problem, because you had a solid tenant base, you lost it all, now you're on month-to-month, there's a huge risk, and you may be making it credit-wise, but what's to say next year you have mass exodus again? So that's where we're going to get the story to see what the future holds.
And what is the checklist of items, Kevin, that you guys need to see on an owner occupied commercial real estate or business sort of
I
transaction?
have, they have a checklist, but like to me, I want to see, they go by the financial statements and all this stuff. I kind of make it up depending on the deal.
Okay.
If it's owner occupied, I want the tenants 3 years,
And no
3 years, 3 years tax returns, and then I'm going to want the year to date for the business. I'm going to want debt schedule for the business. I'm going to want 3 years on the property to make sure the lease that they say they have in place is the same, and I want to make sure the tenant's rent matches up with the lease. So I'll have 3 years of the tenant, 3 years of the owner of the property, and then 3 years of the guarantors, because that's where I'm going to get the global. And I want to see 3 years. But the business intern, that's just kind of see how the business is doing. Because obviously, if you annualize the lease for that year, it's going to be the same as the previous year, or it should be. So I just kind of want to double check to make sure my business is doing good, that occupies and supports the debt. So I kind of make it up depending on what deal we're looking at. Because like an investor, I'm going to need 3 years tax returns, a P&L for where you're currently at, and then a rent roll. And that's kind of it. And then you get the ownership, 3 years of tax returns and a PFS.
And then what is, just so the audience understands, so you got a PFS, which is a personal financial statement.
Yes.
Then you have personal tax returns. Then you have
Business tax returns. And then you have normally a single asset LLC if it's owner occupied.
So you have articles of organization or corporation.
Mm-hmm.
Need information for there. And then a business debt schedule is just showing all of the debts and payments that they have for the business, correct?
That's correct. Because obviously at that point, we're looking at financing the debt on the building, so that we wouldn't need that because that's our debt.
Okay. And then what about accounts receivable or account payable agings? Do you need that?
So I don't typically ask for those on owner occupied, and because I'm just looking at what's the historical of the tenant. But if I'm looking at a line of credit for that as well as the owner occupied debt, then I'm going to want basically the ARs for the previous 3 years to make sure they match your tax returns. I'm going to want your current AR aging to match your balance sheet for the year to date. And I'm going to want the agents to see what historically, basically, if there's any 0 to 30, 30 to 60, 60 to 90, and if there's any ARs over 90, because those get basically discounted or taken out. Also to see if there's cross agings. Accounts payable agings, I don't really look at too deep, but unless I see a huge number which basically balances out the AR, and then I'm going to have a question, but you don't normally see that. So if you have any more questions to that, that's more speaking to the AR line of credit.
Yeah, that's good. Okay. So, and then is there any other, so basically, once you get all this information in, then you spread it, come up with these ratios, and then what happens typically from there? So once you've sort of determined, hey, this makes sense, and I think we can make a deal, then what are you doing from there?
Typically for you, I issue an LOI because I have enough to know that the deal looks good. It's something I feel good with. And as that's the case, we get the LOI out. And then while you guys are doing that, I will put a pre-flight together and I will send it to probably either Chris Rood or my credit guys here in the office. And I go, hey guys, this is what I'm thinking. What do you guys like the deal? Do we not like it? Where do we need to go get granular to make sure we can get past a hurdle that you see right now? Because then once we get to that point, we know the deal's going to be pretty much, it's like a pre-approval almost. And if we can get that means your success rate is 99% after that LOI goes out the door.
So you underwrite it, run all your sort of preliminary spreads. Mm-hmm. You come up with the debt service coverage that works well. You make sure the credit all there, and the character and the credibility and the collateral, cash flow, et cetera. And then we'll run it a letter of interest or an LOI, and
Yep.
then give that to us or the borrower, and then we will get that signed up, and then you're going to take that into underwriting. Is that correct? So you,
Yes. So it depends on so I'll just use Best Way for an example. Best Way, we're putting the LOI before the pre-flight because we're trying to get the full package from them because we don't have it yet. And I think they want to make sure we're in the game to play before. But with, say, Primal Peer, we had everything to make a credit decision up front. And that's why we never got to the LOI phase because I pre-flighted it. I basically sent it for pre-approval because that was a different deal structure. We had everything up front. So it really depends on how we want to put cart before horse or that, because it just depends on the scenario and who our direct audience is. But typically, I like to get a full package, pre-flight it, get the green light, and then we send the LOI. That's the normal way of doing things. That's the standard, but there are exceptions.
and then once it goes into underwriting, then you eventually from underwriting will go in to get a committee approval.
So we have a flat organization here, but yes, at most banks you would go into a committee or you would get it with your credit officers and they'd all sit and discuss. Here, I go to Chris Rude and then I go to Art Rowland, and basically if both of them sign it, the deal's done.
Okay.
Unless it's over $4 million. And then if it's over $4 million, typically we try to go to the chief credit officer because she's the easy to deal with. And once it goes to her, we're good.
So in some institutions, you have a underwriter, then you go into committee. Some institution like yours, and you go straight to
Yeah.
the signers, and then you've got an approval, so commitment letter
Yeah.
that gets issued, signed off, and then you're working on loan documents,
Yes.
preparing for closing. Is that correct?
Absolutely. So typically once you get an approval, depending on what the borrower likes, I know with you like the letter of approval, the LOA. And if you have the LOA issued, then the borrower gets that warm and fuzzy feeling. But most of the time, if they don't care about that LOA, we send out a final needs list for our back office. And the back office will then, once they get the entity docs and some other stuff to make sure we're in compliance, will submit for documentation. And it takes about 3 to 5 days. And then at the end of the 3 to 5 days, we'll be signing. And then normally the next day we fund.
Okay, great. So basically, that was sort of soup to nuts, collecting documentation, doing your analysis to make sure
Yes.
the property itself, cash flow, or the business, I should say, and then that the global cash flow works, and then you essentially take it in for LOI, then approval, and then you go ahead and move towards a close once we do that. So,
Absolutely.
Daniel, do you have any questions at all? Does anything stick out to you or anything that you want to know?
Nothing immediately.
Okay.
However, thank you for doing this. I'm gonna actually rewatch this too, and
Yeah.
I'm gonna study a little bit further.
Good.
This review.
If you send me his email, Dave, I will send you both the template and Tom as well.
That'd be great. We appreciate, Kevin, you taking the time to walk us through this. This is really, really helpful. And,
Absolutely.
so we will wrap it up from there for the owner-occupied conventional analysis project. So hope you have a great day. Thank you.
No, thank you. You guys have a great day. We'll talk.